Thanks for joining us today on Market Call. I'm Morella Fernandez. Eric Nuttall with us on the show today. He's partner and senior portfolio manager at Ninepoint Partners. He'll take your questions on energy stocks today. Here's how to reach us. 1-855-326-6266. You can call in. You can also email your questions. marketcall@bnnbloomberg.ca. Eric, good to see you.
Great to be here.
We talk about the energy needs of the AI build-out, and people are waiting for natural gas to be included in that. It doesn't really look like it's picked up just yet. Do you still see an appetite for natural gas and coming soon?
Absolutely. I think we're in a structural bull market for natural gas, and AI is certainly part of the reason. It's a little too topical. We talk about it seemingly on a daily basis. To your point, it is a little longer term. There's a massive demand by the hyperscalers for power needs today. Certainly nuclear is going to be part of the mix. Lead time, we know, is measured in decades. And so natural gas has really gone from being a bridge fuel to the fuel, not just for data centers and AI, which we think is about 10 billion cubic feet a day, 10 BCF a day of increase in demand by 2030, so a little ways out. What really excites us in the here and now is the meaningful increase in LNG, that's liquefied natural gas demand, both in Canada and in the United States. The U.S. is exporting, depending on the day, roughly 18 to 19 BCF a day now. That's going to climb to 30 by the end of this decade. Canada, we're now exporting roughly 1. That could climb to about 6 by 2030, 2032. And so that's very visible, measurable, high confidence increase in demand. And at the same time, when we look at supply, we think the cost of supply has gone up over recent years. We think is roughly $4, which incidentally is where the strip is. So if I was a producer, I could hedge $4 on average for the next 3 years, so 2026, 27, 2028. And when we look at valuations, we'll talk about some later on in the show. At that natural gas price, these companies are trading at 11, 12, 13, 14% free cash flow yield. So we find natural gas very attractive right now. We have roughly 70% of our equity exposure to natural gas producers in the Ninepoint Energy Fund.
Interesting. Okay. Some say that Canada has been too slow on the infrastructure build out for LNG. I know there are plans to do more, but are we behind other countries on that?
Oh, God, yes. Yeah, it took Canada longer than it took the U.S. to land a man on the moon for us to build our first LNG facility. This is Canada. Things just take longer than in almost any other investable jurisdiction in the world.
Then, having seen what was in the budget, do you feel like we are ready to fast track?
No, the budget was nonsense, right? It was a lot of talk. We've yet to see action. We're still waiting for this government to recognize the importance of even just the oil industry to Canada. It is our largest export. It's 20% of all of Canadian exports. It's by far our biggest product, $100 billion. We are going to run out of oil pipeline by about 2031. And the importance of that is we'll be producing roughly 4.7 million barrels per day of heavy oil by that time. The price of oil or the cost of the discount for our barrels is set not off of the 4.7 million. It's set off one barrel. That marginal barrel dictates the discount for all of those barrels. And so if we run out of pipe, because it takes about 8 years to build a new one, that will cost producers roughly $12 to $13 billion per year. That has a trickle-down impact on both royalties and taxes. And so there's this grand ransom, this grand deal between the province, Carney, government, producers, et cetera. We really need resolvement very, very soon because of that 8-year lead time to build a pipeline.
How long do pipelines last, generally speaking? What is the lifetime of a pipeline?
Decades and decades and decades, especially modern day ones. The interesting thing is, so the original TMX pipeline was built in 6 months. Unbelievable. Okay. So when there's a national will, when there's an urgency to get something done, when there is a recognition that if Canada is able to increase our oil production, increase our royalties and taxes and lift hundreds of thousands of Canadians out of poverty by doing so, if we were at that point in time where there was that recognition, we could get things done a lot faster than 8 to 10 years as currently slated.
Got it. All right, we're going to line up some phone calls for Eric Nuttall, Ninepoint Partners. He's taking your questions on energy stocks today. Here's how to reach us. We're back in just a moment. Stay tuned. Welcome back to Market Call. Thanks for joining us today. Let's go to Jim. He's on the line in Peace River with his question today. Hi, Jim.
Hi.
Go ahead.
Hi, Jim.
Baytex. I'm heavily invested in the oil patch. I work in it all my life. Now I'm retired. Baytex up here in the Clearwater, I can't believe how well they're doing. How do you see them 3 years from now, please? Thank you very much. I'll hang up now.
Yeah, Baytex is a name we've been involved with on and off in the past. They just had a huge announcement last week where they're divesting from their Eagle Ford shale play, repatriating back to Canada. They and other peers that have had cross-border assets never really got the recognition. They were kind of like this stranded company. Like the Canadians didn't know what to do with the U.S. asset. The Americans didn't know what to do with the Canadian asset. I think I butchered that, but you know what I mean.
Yes.
So now they'll be focusing on Canada. As a result, they will have about $900 million of net cash, approximately, once the deal closes. It would be my expectation that they will take the lion's share of that cash and use it for share buybacks, as management views their share price to be materially mispriced. And in so doing, they'll use both their NCIB and I would assume also an SIB, where they'll buy a big chunk, potentially even taking out an overhang that is in the stock now. When they did the Eagle Ford transaction, the vendor took paper, and that's been an overhang on the stock as well. And so what do we have? You mentioned the Clearwater. We love the Clearwater. We're probably the biggest and earliest investor in the Clearwater, outside of Spur. They've done phenomenally well. Baytex, however, I don't think has a lot of running room there. It's a great asset, not a lot of running room. We would view Baytex today as mispriced. However, the one hindrance that we think is that inventory depth. They have roughly 10 to 12 years of drilling inventory relative to other peers, like relative to US Shale Co. That's great. Relative to Canadian guys, be it oil sands, be it other names that we'll talk about, it's a little on the shorter end. So they do deserve to, for now at least, to trade at a bit of a discount. My belief is what they will do is they'll do the NCIB, they'll do the SAB, that will have a very positive impact on the share price. They'll regain a currency. And then what they should do is use that to transact and add to their inventory, because they're really, their skill set now is in the Duvernay, an emerged play, wildly improved economics versus a few years ago. They developed their expertise in the Eagle Ford, which they can now apply in the Duvernay. So it's not a stock we own today. We're a little hesitant on the oil price. We don't think we're going to see 50. We don't think we're going to see 70 over the next, let's call it 6 months. So we prefer natural gas. And for oil, we only own 3 oil names now. We'll talk about one in past picks, one in top picks, and the other one is Athabasca.
Why do you think Eagle Ford didn't work for them?
Well, we're still working. My partner is a geologist. We scrub well data. The asset itself, we believe at this point, worked. However, it just never resonated. Like, this sector's been so out of favor. Like any energy fund, there's only 2 of us left. We get redeemed on a daily basis. We have for 2 years, even though my fund now is matching the NASDAQ year to date. We're up 19%. So it's been a great year, and yet sentiment is still in a funk. So this sector has been out of favor. You look at the United States, energy is now only 2.6% of the S&P 500. It's irrelevant. There's just not enough eyeballs watching these companies. And so for Baytex, they had too much debt at a time, which hindered their ability to buy back stock. At a time when there's an absence of buyers, the companies that have done really well have been those that have bought back their stock. They have not been able to do that. And so I think it was the right decision for them. It probably stung a little, but to repatriate back to Canada, we've got 7 of the top 10 most economic plays in North America. It was the right call, and I think the stock will eventually regain its lost traction.
Okay. Let's move on to Greg then. Greg's in Winnipeg with a question. Hi, Greg.
Good morning. Eric, would you give your assessment of Chord Energy?
You bet.
Buyer, and do you see it returning to past highs? Thank you.
Okay, tell us about Chord Energy.
Yeah, so Chord is a pure play Bakken player. We've talked about it in the past. We've recommended it in the past. It has been a poor performer. This is the poster child of a mid-cap, the market cap's, $5.5 billion US right now. So it's the poster child of a mid-cap oil American company at a time when everybody just wants to buy Bitcoin or NVIDIA. Nobody cares about energy. This company's been actively buying back stock, but it hasn't been able to stem the bleeding. Operationally, they've been doing just fine. They have better than average inventory depth. We would measure it again, roughly 12-ish years of drilling inventory. And at $60 oil, it's trading at 3.3 times cash flow. So inarguably, it's very, very cheap. I struggle with it at a time when energy is only 2.6% of the S&P 500 and there's a zero care factor. I'm challenged to see how a name like this could outperform. And so it's tax time. I would suggest perhaps if you're sitting on a loss and you need some losses, maybe take the loss and roll it into a name that we'll be talking about later on. Well, you'll get your oil exposure. It's going to be Canadian. You'll get a dividend, equal balance sheet strength, all of these different things, and even better drilling inventory depth.
Okay. Let's move on then to Daniel. He's in Markham, Ontario with a question. Hi, Daniel.
Hi Hi, Marilla. Hi, Eric.
Hey, Daniel.
My question is on Athabasca Oil. What has led to the success of its share price despite lower oil prices?
Yeah.
And what companies can be the next Athabasca Oil and replicate its playbook? And also, Eric, one of the best guests on Market Call, come more frequently. Thank you.
No, thank you very much.
Question. Go ahead.
We search daily for the next Athabasca. We bought this stock at 17 cents. It's probably one of the biggest home runs I've had in my 24-long career, with more years ahead. But this has been a very special name. There have been two reasons why it's done so well this year. The first is they were the company to embrace our philosophy, our strategy, and adopt the share buyback playbook to such an extreme. They've been massively buying back their stock funded out of free cash flow. They have the asset duration to do it. They've got roughly 70 plus years of stay flat inventory. So that's been helping them. They're hoovering up shares. The second thing is we had Strathcona go hostile on MEG, ultimately losing, fortunately, to that. Cenovus just closed its first day of trading, Cenovus post MEG not being on the board. And so you've got a recycling of proceeds, we think, from if you're a holder of MEG, you're an oil bull and you like mid-cap stocks, you're probably not going to hold on to Cenovus. So now you're searching at what's the next name I'm going to own? It's going to be Athabasca. It's the closest parallel between Athabasca and MEG. And so we think it's been those two dynamics. We look at valuation, for sure, there's a bit of a premium in it. At $60 oil, it's trading at 8.3 times forward cash flow. That's the highest multiple I've ever seen in this name. They have one of the best remaining sanctioned, approved projects, greenfield projects, called Chord, which we think that they'll be going ahead with. It's a 40,000 barrel per day project, first oil around 2029 in modular stages. Any sale of this stock has been a bad sale. So it's about a 5% weight for us. Even though we're a little cautious on oil, somewhat cautious short term, we're going to stick with the shares that we own because we see very meaningful long-term upside in this name. We think we'll see $80 oil in the not too distant future. At 80, we think this stock has very, very meaningful upside.
What's your optimism? Where's that optimism on oil coming from?
So it comes around, demand is coming in much stronger than consensus believes. Everybody is anticipating the largest supply-driven glut in history. We're not seeing it. I put up on a chart on Twitter this morning showing we've had this huge build in inventories offshore because of sanctions. Mm-hmm. We're just not seeing it onshore. When we look at the biggest marginal barrel has come from U.S. shale over the past 10 years, that is coming to an end. And lastly, when we look at OPEC, we think they have fully normalized their spare capacity. We think the spare capacity within all of OPEC is only 1.4 million barrels per day. Demand right now is at roughly 106.5, 107 million barrels per day. So that's a very, very razor-thin margin. It's like having a house with no fire insurance in a neighborhood full of arsonists. That is how fragile the market is now. And so sentiment, there's some uncertainty over the short term. At some point in 2026, people will look beyond that to a world where we've run out of OPEC spare capacity, we've lost the largest source of incremental barrels, and you just had the biggest bear in the world, the IEA, say, well, geez, we've been saying peak oil demand is going to be happening in a year. Well, in fact, it's not going to be happening until 2050 or beyond.
Yeah, they just pushed that out. Okay, we're going to take a quick break. We'll be back with more of your phone calls in just a moment. Stay tuned. Welcome back to Market Call. Let's go to Colin on the line. He's in Sarnia, Ontario, with a question. Hi, Colin.
How are you doing? And thanks for taking my question. Eric, I know you like to move things along, so I'll try to giddy up here. Strathcona Resources, they seem aggressive enough to grow at any cost. And I'd also like your opinion on the U.S. forcing their hand in Venezuela, bringing Venezuelan crude back onto the market.
Yeah, that's something we're watching. Like you've got the massive fleet just offshore Venezuela. It would be near-term bullish but medium-term bearish for oil because if Trump really wants to affect regime change, Venezuela is one of the only areas of latent productive capacity. Production today would be roughly 700,000 barrels per day. You could see that get back to 2 million. Now it's going to take a lot of money in probably 4 to 5 years, 80 billion roughly. Okay. But, there's productive capacity there. Strathcona is not a name that we own. It's not a name that we're supportive of now. Adam Watters has created a tremendous amount of money for his clients, his investors. So a lot of respect from that. We kind of went head to head where he put MEG in play. MEG has been a name that we've made generational wealth from over the years. Rotten timing, and it forced the hand of Cenovus to come and take them prematurely. Strathcona suffers from liquidity challenges. They are eventually divesting more and more of the shares to unit holders of the Waterous Energy Fund. So over time, that should improve. I do think one of the motivating factors for MEG was to improve liquidity in a much, much faster manner, and that failed. And so when I look at premium valuation, when I look at leverage, when I look at asset quality and lack of liquidity, I think there are better names to be invested in right now.
Okay, good to know. That was for Colin. Let's go on to Elliot in Hamilton, Ontario. Hi, Elliot.
Good afternoon. I recently heard of RockPoint Gas Storage. Mm-hmm. Is this a company with some significant growth potential, or is it a dividend payer? If so, what is the dividend? Please, your thoughts on RGSI. Thank you.
Yeah, so it's one of they're the only gas storage, is my understanding?
Only public one, yeah. So they went public via RBC. We participated. The stock's been done quite well. We bought it in our energy income fund. Yield today would be about 5%. It's really a total return name. So you get organic growth, you get recontracting, and then you've got the dividends. So the total return is roughly 15%. It's interesting that natural gas is one of those few markets where we talked about LNG demand growth. We talked about AI demand growth. There's been no lack of increase. So there's no increase in storage meaningfully. So the market's grown massively, but it's subjected to Mother Nature. Like here we sit on forecast for a very cold December, potentially for the wintertime. You can very quickly take inventories from the top of the range to the bottom of the range and get a price spike. So this is a company that can benefit from that because they offer storage. It's strategic by being able to arb the spread and potential periods of volatility. And so it's a name, we did take our profits. We didn't get a huge weight. It's a little thin for us, but it's a very intriguing name. Collect the 5%. If you own it, sounds like you do. I would just let it ride. I think it's a very intriguing name.
Okay. Let's go to David then in Ottawa with a question. Hi, David.
Good afternoon. Thank you for taking my call.
Hi, David.
My question is on CNQ. I've noticed that CNQ is about 20% below the 52-week high, and yet Suncor is reaching a 52-week high. Now, both companies are great Canadian companies, and I own both. Is there a reason as to why Suncor is doing a lot better than CNQ, and do you own either of these stocks? Thanks a lot, and have a great day.
Yeah, we own neither. I have tremendous respect for both companies and both the CEOs / the management team of CNQ. I think both are fairly valued right now. Barring some geopolitical event like Ukraine striking actual production within Russia, not just export terminals, refineries, and actually removing meaningful barrels, I'm challenged to see oil spiking over the short term. At $60 oil, so roughly where we're trading, CNQ trades at 8.4 times cash flow, 7.5% forward free cash flow yield, 5% dividend yield. To me, that's a fair multiple. Suncor, slightly less than that, but still very full. It's the reason why I'm very biased in this, but we think that we can add meaningful outperformance going forward because everybody's been hiding in CNQ. If you're a generalist investor in Canada, you never get fired owning CNQ because it's a very, very well-run company. But if I'm directionally accurate that we're in a multi-year bull market for natural gas, that we're not that far away from $70 plus oil, eventually people want to go down cap. And so my suggestion to you is there are meaningfully better names where you get a higher yield, like kind of asset quality / drilling duration, stronger balance sheets at maybe a $13 billion market cap and not a $100 billion market cap or $98 billion market cap. So we've got all the respect for Murray Edwards and his team. We just think the stock is fairly valued. And unless you're a meaningful oil bull longer term, there's no reason to own it right now.
Got it. Okay. Let's move to an email then from Peter in Toronto. He says, thoughts on oilfield service providers. Please provide 2 or 3 points. Pro versus con. So here are the names. Trican Well, TCW, Total, TOT, and then Ensign, ESI. Or Precision Drilling. I would say take 2 of them out of the 4.
Yeah, so we've got a pressure pumper, compression, and 2 drillers. Ensign's got too much debt. Precision's got good leverage to U.S. natural gas. We do think there's a meaningful call on natural gas growth in the United States. Demand's going to grow by LNG by about 4 Bs a day per year for the next, let's call it 5 years. Trican stumbled recently. They indicated there's a little more wipe space on their board. Stock had done very well, so I think it was easy for people to take profits. It's challenging. The services sector is very tough. You're offering a homogenized service, generally speaking. There's a number of bad actors always. So anytime you get pricing power, at the first whiff of a downturn, somebody cuts price, you've got a match, and suddenly your margins go to near zero. You have no pricing power. So I just think going forward, you can make meaningfully more money in the producers. The exception to that is offshore drillers. We think that's where the puck is going. We have no position today, but it's something that we're doing a lot more work on. But onshore North American services isn't an area that we have an interest in right now.
Okay. We're going to take a quick break. We will be back with a look at Eric's past picks. That's coming up next. Time now to go through past picks from Eric Nuttall from September 13th of 2024, so over a year ago. MEG Energy was the first pick at the time. It was $24.29, and now under Cenovus banner, it's $30.89, a return of 27% upside, 29% total return. So this was a full year ago. And when did the first offer come on the table, Strathcona?
I think it was roughly, oh God.
April? Something like that?
Something like that.
Okay.
I was down, it was around
Yes.
March's break or spring break. So I remember waking up, had my family on a mini vacation. I woke up to the news, and my phone blew up as soon as I turned airplane mode back off. MEG Energy was such a special name. I'm really, really disappointed to have seen it go. They were a very shareholder-friendly management team. I really like Darlene, the CEO. They were practicing the philosophy of meaningful share buybacks over time, and it was really going to be a poster child to see how meaningful share buybacks accumulated over time was going to lead to a meaningfully higher share price. We thought fair value, like again, I think we'll see $70 at some point next year, $80 the year thereafter. Goldman just came out and said directionally the same thing. Like at $80 oil, the stock is easily worth $50. So I feel like as a result of Adam Waterous having put this in play, he and others tripped over pennies on their way to dollars. Like they did fine by it. I think his cost was 26 roughly. It's 30, so he made good money. But we could have made just so much more money over time on this one. And it was actually my third large holding being taken over this year. And so it's symptomatic of a market where sentiment remains challenged. Fundamentals are extremely strong as measured by free cash flow. The balance sheets are very strong. We see U.S. companies coming to Canada and sniffing around because we have drilling inventory, all these reasons. And my fear is we're going to lose even more of the best companies at what I would still call the bottom of the cycle or near the bottom of the cycle.
Got it. Okay, let's get to your next past pick from September last year, Tamarack Valley, TVE on the TSX. We'll have a look at what it was at the time, $3.83, and now at $6.99, short of 7, 82% return and 87% total return. Yeah. Is this a company you have held on to?
Yes, and we continue. I think we're one of their largest shareholders. What we like about Tamarack is, again, they've beat expectations 7 quarters, 8 quarters in a row. We had our moments with them years ago, and they really, I have to give them credit, having turned the story around, divesting out of somewhat more boring, tired assets and really focusing on the Clearwater. They've got another secondary asset, but it's really a Clearwater name. The Clearwater, the reason why the stock has been doing so well is they're experiencing remarkable success in using water floods. Mm-hmm. So that's you inject water in, you repressurize the zone, production either stabilizes or in fact can actually increase. They've been experiencing spectacular results. So the cost of those incremental barrels is very, very low. You can recycle your cash flow and your free cash flow that much faster and buy back that much more stock. So we only own 3 oil names right now. One is going to be a top pick. The other is Athabasca, we've talked about, and Tamarack is one. We're very comfortable. It's roughly a 9% weight in the fund. At $60 oil, again, you don't have to believe in 70 or 80. At 60, we have it trading at 5.2 times and about a 10% free cash flow yield. They would have at least, we think, 20 years of stay flat drilling inventory. And my hope is there'll be further consolidation where there's a company called Headwater. It makes all the sense in the world for, at least for the Clearwater assets within Headwater and Tamarack to merge. You've got cost synergies and all these different things. The Headwater guys can go and find new barrels. They're very good at that. So this is a name we continue to hold, and we will continue to hold.
Okay. Let's get to your third pick then. Freehold Royalties, FRU on the TSX. At the time, so last September, it was $13.43, now to $14.76. 10% upside here in return and a 19% total return. How do you feel about Freehold at this point?
Yeah, we continue to hold it as one of our largest weights in our income fund. I own a big whack of it personally. This was never intended to be like a shoot the lights out recommendation. It was at the time, it would have been yielding roughly 8%, which we didn't think was appropriate. It's yielding today 7.3. They're one of the largest leaseholders now in the Permian, where the Exxons of the world, Exxon's one of their biggest clients, if not the largest client of theirs, pays them a stip and royalty on almost every well that they're drilling now in the Midland. This stock can yield roughly 35 years of drilling inventory that they think they have between Canada and the U.S. Canada 30, U.S. 40, so call it 35. And at a time when their Canadian production has been stagnating, they're now experiencing growth in the U.S. And so it kind of validates their strategy pivot from a few years ago to pursue the U.S. They viewed Canada as a little more tired, a little more difficult to drill. They see opportunity in the United States, and I think that's paying off. And so this is a company where you get modest volume growth, it's really about collect your dividend, and as we think oil and natural gas both appreciate over time, you'll see small incremental dividend bumps along the way. But for 7.3% yield right now, we still think this is very attractive.
Got it. Let's get to a quick break. We will get to more of your phone calls with Eric Nuttall of Ninepoint Partners when we come back. Stay tuned. Welcome back, and thanks for joining us. Sylvain is on the line in Montreal with his question today. Hi, Sylvain.
Hi, good afternoon. I would like to know your outlook for Tourmaline, please.
Sure, you bet.
Thank you.
We're very bullish on natural gas. We are not bullish on Tourmaline short term, and I would say it's a very out of consensus view. From watching the show and seeing, any time a guest says, "Oh, we like natural gas, we like Tourmaline," so it's a very, very well held name. And yet, I believe it's now the worst performing natural gas stock in North America year to date. The reason for that, I believe, is one, it's widely held. Two is they have a unique strategy where they're pursuing a heavy CapEx program in lieu of share buybacks at a time when there is an absence of natural buyers because energy remains out of favor. To their credit, they're spending money on more infrastructure projects to increase margin per barrel. They're not necessarily growing volumes that dramatically. However, they still are. Like we would have them organically growing their natural gas next year by, let's call it 300 MCF, 0.3 BCF a day. So okay. It's modest. But it's that action of heavy CapEx, low share buybacks, well owned that I think is resulting in underperformance. And because they've outlaid this 5-year plan, now we have to wait till like 2031 or something before we see meaningful share buybacks. So who knows? Mike Rose and his team, they've created phenomenal amount of wealth. And I don't think many people have done well to bet against him over the long term. It's a difference in philosophy and strategy where I'll speak to a name later on. It's the largest natural gas producer in North America. And in contrast to meaningful growth going next year and going forward, they're saying, look, we don't see the price signal, we're not going to grow. That's the American way, not the Canadian way. We prefer U.S. exposure for our natural gas. And so if you own it, if you're sitting on a loss, perhaps take the loss. It is tax time now, and listen to the pitch in about 20 minutes' time.
Okay. Sylvain, I hope that's good for you. Let's go to Nyron in Scarborough. Hi, Nyron.
Oh, hi, Mirella. And this question is for Eric. It's on NuVista.
Sure.
So I heard you once before said that you were going to oppose the takeover. Is the takeover still going to be in effect? I mean, considering where the stock has come from in the last 5 years, January 2020 was a 30-cent stock. It's now topped over $18. So I just want to find out from you if you can give some guidance where the stock is getting.
Okay, I think the biggest mistake an investor can make is to look at where a stock has been as opposed to where it's going. This is a stock, I bought 1 million shares from my fund at 17 cents during the COVID lows. So it's done well. However, this was what we thought were going to be one of the best performing stocks in Canada and North America going forward. The reason for that is they have decades worth of super high quality inventory, a very, very shareholder friendly management team that was both organically growing oil volumes, gas as a byproduct, and also buying back their stock. Jim Riddell, his sold stock, I think, to Ovintiv. I don't think we've seen the circular yet, but that's to be confirmed. That put them in play. I believe his cost base was roughly $260, so he had a phenomenal pass on the stock. It remains a 12% weight in our fund. We're the largest holder after Ovintiv and I think Jim. We're still doing our work on Ovintiv. As of right now, it's our intention to vote down the deal. We think that, again, it's tripping over pennies on our way to dollars. It's another example of a casualty of very poor sentiment. And we look at this stock where, even with the run, it's only trading at 5 times, that's at $4 gas and $60 oil. We're bullish on condensate. We're bullish on gas. We're bullish on companies with decades worth of inventory that can, grow. They were going to be growing from where they are now to a little bit more and then holding that production flat and just buying their stock back like mad. So I don't fault the board. You get an offer in hand. They always consider upside and downside. Mm-hmm. But as an investor that scours the world for energy opportunities, I was hard pressed to find a better one than this. And so as of now, it's subject, every day is a new day, but it's our intention to vote against this deal. When is the vote? Early next year, I think.
Okay. All right, let's go back to the phone lines. Amin is on the line in Ottawa with a question. Hi, Amin. Amin, are you there? Amin? Okay, I think the question was about ARC Resources. So we'll talk about ARC Resources as a natural gas play. It's also quite down.
Yeah, it has. So they have stumbled, and they're owning the problems that they have had. So a lot of the story, it's meaningful, but not that meaningful in the grand picture in terms of as a company. However, they had this one growth project called Hitachi, and they'd really sold the sizzle to the market about super economic, condensate, and all these different things. And as they've been developing that project, they've had significant teething issues to date. I won't bore you, and it'll take up too much time. They think they fixed it. It's going to take time to prove to the market that they have fixed it. So it's probably going to take another, 3-4 months to demonstrate that they fixed it. So between here and then, it's probably in a holding pattern. Last week, Terry, the CEO, I think, bought $1.1 million, roughly speaking, of stock. That's a good sign. I'd love to see even more. I'm no doubt they own stock, but I'd like to see more to corroborate that. We were buyers on weakness. We think there is long-term value in this name, although we admit that maybe it's going to struggle until they come out with well results on their next pad to demonstrate that they have, in fact, fixed it. We look at it, it's trading at 4.8 times cash flow at $4 gas and $60 oil, so roughly where we're trading today. We think that if they're successful regaining their multiple, it should trade at 7. That'd be about 50% upside over the next year to 2 years, something like that.
Okay. Let's take a quick break, then we'll get to more of your questions when we come back. Stay tuned. Welcome back. Let's go straight to the phone lines. Dennis on the line in Victoria with a question. Dennis, what's your question today?
Hi. I've owned Suncor and CNQ for many years, and we sell most of our heavy oil to the United States. So, Eric, I'd like to know your opinion about the competitive threat from Venezuelan oil on Canadian oil producers and pipeline operators, as President Trump seems very interested in Venezuelan oil.
I agree. It's something that we're watching. It's the biggest competitive threat for Canadian oil, which is Venezuelan oil. The U.S. Gulf Coast was geared to produce our oil. However, if there are substitutes, it could argue for a wider differential, which behooves us as a country for what is our largest export. This is a $100 billion per year product. It's 20% of our net exports. The fact that we can't recognize as a country and a government of the strategic imperative to build out more pipeline. Like, how is it possible that a steel tube that transports a product that everybody on planet Earth uses, and if we increase the capacity, could lift hundreds of thousands of Canadians? How did that ever become so controversial? But here we are today. For Suncor, it's not a name that we own now. I have all the respect for Rich Kruger. He's done like a spectacular job of turning this company around. One day there will be a statue of Rich somewhere in downtown Calgary. However, because he's done such a good job, the stock's trading at a fair multiple. We have it at 7.6 times cash flow and a 6% free cash flow yield at $60 oil. That's fair. Like, that's not maybe overvalued, but fairly valued. We're looking for names where we can make our clients, we think, at least 30, ideally 50% over the passage of time. This isn't one of them right now, unless oil meaningfully rallies. So again, we'll have an oil name later on in a few minutes where we think that even at a flat oil price, the stock can go up meaningfully.
Okay. Let's move on then to Kisha, who's calling from Vancouver Island. Hi, Kisha.
Hi. Thanks for taking my call. I've held Headwater and I'm now up, but with your thesis on oil, should I let it go and add to ARC? Thank you.
Okay, thank you for the question.
I could see the temptation. Headwater, we've owned in the past. The challenge, again, not to keep beating a dead horse here, but sentiment is challenged. There's not a lot of natural buyers. This company isn't really buying back their stock. I think they just did for like the first time in 2 years or something a month or two ago. It's complicated to follow all their different assets and all their different plays and what the upside is. So I just think they haven't communicated the story as well as they have. With that said, though, it is trading on our math. I haven't looked at this in a little while, actually, 6.5 times. So that's a premium, material premium to a name like a Tamarack. So on that basis alone, and a 5.3% yield, I always think like a fair value for a mid cap like this is roughly 6, depending on the name. To us, that implies actually negative upside at $60 oil. So perhaps taking chips off the table and investing in, I'll give you 3 names in a few minutes' time, or even there are energy funds out there that offer good upside and risk management and diversity as well. Maybe even consider that.
Okay, let's get to an email then from George. Could I have your views on BP? I understand they are one of the biggest producers of natural gas in the world, and that email is coming in from George. You like BP?
BP is a bit of a joke of a company. It's gone from beyond petroleum to, it's gone from British Petroleum to beyond petroleum, yes. Now back to petroleum because they pivot. They incinerated billions of dollars pursuing the dream of alternative energies. This was at the time they bought into the IA, peak demand's right around the corner. We need social license. We need to transition. And as a result, they've torched so much money over the years chasing that as opposed to just sticking to what they actually had a credible skill set in, which is producing oil and natural gas. And it speaks to these European companies. They suffer from lack of inventory depth, horrendous fiscal prudence over the years. And you contrast that to Canadian companies. If you really had to force me, I'd say sell it and buy a Cenovus. I think one is meaningfully more attractive than the other with similar-ish market cap.
Okay. Let's go to an email from Murray. He says, I'm interested in Obsidian Energy. Not familiar. Tell me about that.
Yeah, so Obsidian is, I've struggled with them in the past. So they have somewhat of a contentious CEO. He's a hedge fund guy out of New York. They've been putting up fairly good well results. It's a $650 million market cap company, which is beyond irrelevant for almost all institutional investors. I couldn't buy that. And so I think there are names like this where it's time to pass the baton off to a larger, better capitalized company, whether it's going to be a Baytex, whether it is I don't think Tamarack would fit, but there are other natural owners of these assets. And, as I'll speak out of both sides of my mouth. On one hand, I really hate seeing my champions get stolen from me. But at the same time, there is the need for consolidation from companies such as an Obsidian, where I just think they're going to struggle. Like it's been flat for 4 years, something like that. Like it's just, there's no buyers of these stocks. So unless you're actively buying back their stock, which I don't think they are massively, there's no natural buyer. So there are better names to own.
Okay. Let's leave it there for phone calls and emails, but Eric has new top picks. He'll share that when we come back. Join us tomorrow on Market Call. Colin Szynski will be on the show, Chief Market Strategist at SIA Wealth Management. He'll take your questions on technical analysis. That's tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time for new top picks from Eric Nuttall. We begin with Whitecap Resources, WCP, on the TSX. What do you like about Whitecap?
Yeah, so Whitecap is one of the few oil names we own today, given our somewhat cautious short-term view on oil. At $60 oil, it trades at one of the lowest multiples of the mid-cap Canadian producers, despite having a lot of attributes which we really, really like. They bought Varen from us earlier this year. It really puts them in pole position in terms of asset quality and duration. They have at least 25 years of really, really high quality stay flat inventory. So that means that they don't have to burden themselves with future M&A, creating overhangs. They've got enough drilling inventory. When I look at in terms of the dividend yield, they yield 6.6%. That's sustainable down to roughly $50, $51 oil, not a price we expect to see. So you get paid. And I mentioned as well, even at $60 oil, we have it trading at 4.8 times cash flow. Its peers are trading closer to 6. At a 6 multiple, again, at the oil price, which you see currently on the screen, we would see roughly 42% upsides. That's called a $16 stock. I think at some point in 2026, the market's attention will go from the invisible, oil glut story narrative, which isn't happening yet, to the twilight of U.S. shale, demand growing for the next several decades, and OPEC running out of spare capacity, which is because right now it's only 1.4 million barrels per day. So if you dare to dream in even just 70, which isn't that much of a stretch, to us that would be about a $19 stock, and at 80 it'd be about a $23 stock. So in my mind, it's low risk, very low balance sheet, low debt, strong balance sheet, high asset duration, very shareholder-friendly management team. Grant continues anytime the stock sells off. He's on the board buying stock personally, so you've got insider ownership and alignment there, and you've got really, really good quality inventory that seemingly gets better and better and better over time. So we like this one a lot.
Okay, that's Whitecap. Let's get to your next new pick, Expand Energy, EXE, on the NASDAQ. So they do natural gas in North America. So how widespread are they?
They're the largest producer of natural gas in the United States or / North America. They would produce about 6% of U.S. Natural gas production. What we like in the United States is it's less of an oligopoly in Canada. So more people control the volumes, but they act more responsibly, where at times of low natural gas prices, they both curtail production, so they shut it in, literally turn the taps off, and they stop drilling. Canada, we haven't figured that quite out yet. So it's a better natural gas market. Secondly, so they're in the Haynesville and in the Marcellus. So they're closer to the areas of demand growth. AI data centers in Texas, AI data centers in the Marcellus, Haynesville, supplier of U.S. Gulf Coast, so they get a better realized price. When we look at the natural gas price I mentioned earlier in the show, if you look at the strip, so what a producer could hedge, it roughly averages $4 for the next 3 years, so 2026, 7, and 8. At $4 gas, it's trading at a 12% free cash flow yield. We would anticipate getting at least half, if not more, of that back in the form of buybacks next year, and that ratcheting up. And the sensitivity to these names, if you went from $4 to $5, which is not out of the realm of possibility if we just have a normal winter, potentially much higher than that, you just go from $4 to $5 natural gas, their free cash flow yield goes from 12% to 21% free cash flow yield. And yet they've got well over 20 years of inventory. So they'll be actively buying back their stock. You get strong asset duration. And if anybody's bullish on NVIDIA and Meta and tech and the Fab 7 or Mag 7 or whatever, you've got to be bullish natural gas, because without natural gas, without the power, none of the rest of that bullish thesis makes any sense. And so it's really an extension of that investment.
Okay, let's get to your next top pick, Antero Resources, AR, on the New York Stock Exchange. Tell me about Antero.
So Antero is a natural gas / liquids producer. It'd be like propane and different products. So I really view it as a natural gas with beta on the oil and product pricing. They are a $10 billion market cap, so big enough to be relevant to most institutions. They offer significant leverage to a rising natural gas price, where at the current price, again, I mentioned $4 for the next 3 years, it's trading at a 13% free cash flow yield, which is very, very attractive. Again, if weather cooperates, all these different things, we think $5 down the road. Morgan Stanley has that as their base case for all of next year, I believe. At 5, they'd be trading at a 22% free cash flow yield. And again, they've got several decades worth of what I call premium drilling inventory. So it's not like in U.S. shale where you've got 3-4 years and you've got to figure out what to do. For natural gas, you don't have to worry about OPEC. You don't have to worry about geopolitics. You don't have to worry about, my God, is Trump going to invade Venezuela? All of these different things. All you have to worry about is the United States is going to meaningfully increase LNG demand. The gas has to come from somewhere. It's going to come from areas closest to the supply sources, the Haynesville. Data centers, AI, hyperscalers, less significant, but still relevant. 10 BCF a day by the end of this year. in a market where we think the marginal cost of supply is 4. Like as an investor, you want to buy into a commodity when the commodity price is trading at or below the marginal cost of supply, because that's pretty much basement level when demand is positive as it is.
Okay.
That's where we are today with natural gas stocks. And it's the reason why in the Ninepoint Energy Fund, we would have roughly a 70-30 mix between natural gas and oil. You can get names with decades worth of inventory trading at very, very inexpensive valuations as measured by free cash flow yields with a very positive thematic overlay of data centers and hyperscalers and the demand for power, not tomorrow, but yesterday. And the only solution to that is natural gas.
And natural gas, you said, sitting at about $4. You see it getting up to $5 next year?
Potentially. Like we use $4 as the base case. 1, it's stripped. 2, we think that's a marginal cost of supply. Thirdly, I'm a horrible predictor of what the weather is going to be like. I have to live by weather models now, given our weightings, but we think just with average weather and the build out of LNG and AI, there's a very, very bullish backdrop for natural gas. And these stocks are not reflecting the present, i.e. the current price, let alone where the gas price could get to.
Got it. All right, Eric, I got to leave it there. Thank you for coming in.
Thanks.
And thank you for joining us today for Market Call. We'll see you back here again tomorrow.